Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone. Welcome to Accredited Investor Markets Radio. I am Christopher Cahill. Later, I'll be talking with Christopher Orr. Christopher Orr is a director of institutional products with a private equity focus at PENSCO Trust Company, which is a custodian of securities and other things. And Mr. Orr works with clients who are pursuing retirement savings goals by means of self-directed IRAs. They want something in the IRA, he can put it there. But first, let's talk about the Devil's Financial Dictionary. That's the name of a new book by Jason Zweig. Jason Zweig is the author of the Intelligent Investor column in the Saturday and Sunday Wall Street Journal. It's a great column. I've quoted it many times on this show. And now he has written a book. Why do I say Devil's Financial Dictionary? Emphasizing the word financial. It's because Zweig expressly models his book on The Devil's Dictionary by Ambrose Bierce, which was published in 1911, the first time under that title anyway, and which is known for its pithy, caustic, and sarcastic way with illustrating human folly through a variety of definitions of words. Ambrose Bierce was born in 1842 in Ohio and is listed as dying circa 1914 in Wikipedia, and there's a reason for the circa we'll get into in a moment. Bierce was a soldier in the Civil War. He was a journalist afterward, a short story writer, including ghost stories. My personal favorites are his accounts of battles in the war, which were factual. One's called What I Saw at Shiloh. Another is called Chickamauga. Obviously, those are battles. And a third is his most famous of this sort of work, An Occurrence at Owl Creek Bridge. And these works demonstrate that simply arraying facts with regard to events like these and propelling them forward with clean, simple prose is devastating. A great writer. Well, as Douglas MacArthur said to Congress in his farewell address in 1951, old soldiers never die, they just fade away. Well, Ambrose Bierce faded away circa 1914. He was in Mexico, last heard of in the company of Pancho Villa's army in the Chihuahua region, and his disappearance remains a mystery to this day. As a journalist, Burroughs was controversial, satirical, a social critic, really, in the late 19th and early 20th centuries, writing of war and politics, finance, all of them as species of human folly. Well, let's get to a few examples from the Devil's Dictionary that may be relevant to Zweig's more recent work. The first is Ambrose Bierce's definition of finance, a noun. The art or science of managing revenues and resources for the best advantage of the manager. You see where the reputation for satire comes in. He defines the word hand as a noun, meaning a singular instrument worn at the end of a human arm and commonly thrust into somebody's pocket. He defines responsibility in a manner recognizable to those of us who have watched financial players shucking off their responsibility for acts that occurred. Responsibility, a noun, meaning a detachable burden easily shifted to the shoulders of God, fate, fortune, luck, or one's neighbor. In the days of astrology, it was customary to unload it upon a star. Finally, lest one thinks he simply takes shots at others, his definition of the word selfish, an adjective, meaning devoid of consideration for the selfishness of others. Before we get too confident in our judgments about the morality of others, we should take a look at what is driving us. Well, I shouldn't let this go without taking a look at two of his shots at my profession. I am a commercial restructuring attorney by day and podcaster by eve. Ambrose Bierce defines a litigant as a person about to give up his skin for the hope of retaining his bones. And he defines litigation as a machine which you go into as a pig and come out of as sausage. Well, that's all good fun, especially those last two. But let's look at Mr. Zweig. What does he have to offer in the way of a new definition in his, or of definitions in his new work, The Devil's Financial Dictionary? Well, he defines structured products. Now, structured products, that sounds like one of those complex instruments to which evil is attached in connection with the financial crisis, evil, at least by some people. Well, he defines structured products as investment products structured to be profitable to the firms that sell them and incomprehensible to the clients who buy them. Sounding very much like Ambrose Bierce's definition of finance. And the problem, Mr. Zweig says, is if you're dealing with somebody in the financial industry who throws jargon at you, there's a very powerful temptation to pretend you understand what the person means, even when you don't. Now, Zweig speaks about his new book at length in an interview in Quartz magazine, Quartz, found at qz.com. And the interview is entitled Jason Zweig on Wall Street's Big Lie. The interview was conducted by Matt Phillips and published on December 9, 2015. Now, what about those structured products? What are structured products in a more orthodox definition? Well, one could go to Investopedia. That's a good source for definitions of this kind. And you find that structured products, the definition on Investopedia, if printed, which I just did, is over 4 pages long. And it starts with a question: what are structured products? And the answer begins, structured products are designed to facilitate highly customized risk-return objectives. So there's no straight answer to what a structured product is. The lexicographers over at Investopedia have to start with sort of what they do or features of them. Let me just read the rest of the 2 paragraphs I'd like to read on structured products from this definition. This is accomplished by taking a traditional security, such as a conventional investment-grade bond, and replacing the usual payment features, e.g. periodic coupons and final principal, with non-traditional payoffs derived not from the issuer's own cash flow, but from the performance of one or more underlying assets. Payoffs from these performance outcomes are contingent in the sense that if the underlying assets return X, then the structured product pays out Y. This means that structured products closely relate to traditional models of option pricing, though they may also contain other derivative types such as swaps, forwards, and futures, as well as embedded features such as leveraged upside participation or downside buffers. Okay, that was 2 paragraphs. I challenge you to tell me what that meant. I'd like to know. I'll have to study that definition at great length, but now you can see the force of the definition Jason Zweig used, which was structured products are investment products structured to be profitable to the firms that sell them and incomprehensible to the clients who buy them. Let's go to the interview. Christopher Orr is a director of institutional products with a private equity focus at PENSCO Trust Company, where he has spent the past 5 years working with clients with regard to pursuing their retirement savings goals by means of self-directed IRAs. Chris has experience with a variety of private equity investment types, from private corporate stock to hedge funds, LLPs to LLCs, and much more. His work with high net worth individuals, advisors, and asset sponsors is what keeps him busy all day. Speaking of keeping busy, he found the time to write an article which is posted on accreditedinvestormarkets.com, a very good article in my opinion, entitled A Little Known Option for Investing in Private Equity, and it's posted September 24, 2015. I invite you all to read it, and we'll cover some of that subject matter today. First, a disclaimer. PENSCO Trust Company performs the duties of an independent retirement custodian and, as such, does not provide investment advice, sell investments, or offer any tax or legal advice. Christopher Orr, welcome to the program.
Thank you very much, Chris. Very happy to be here. Thanks for having me.
Well, now, I think I just answered my own question I'm about to ask, but I invite you to expand on it. What is PENSCO, and what is a custodian, and what is a custodian not?
Sure. So PENSCO Trust is a custodian, as you said. We specialize in retirement dollars and accounts. We help individuals directly invest their retirement money into non-exchange traded assets such as real estate and private equity, as you mentioned. As a custodian, we want to help facilitate that for our clients. What we are not is a fiduciary or a broker-dealer. So as you said in that disclaimer, we don't advise investments or tax or legal advice, but what we want to do is help make it possible for our clients to invest in what they know and love.
All right, along those lines, you specialize in self-directed IRAs. I was wondering if you could comment on how those are different from other IRAs. Maybe it's obvious from the title, but please say so anyway. And how does that open the way to individuals holding what are called alternative assets?
Absolutely. So with a self-directed IRA, it's still an IRA just like any other account you have. The difference is this is an IRA that you're going to be picking all your investments in, and it's a little different from picking a mutual fund or something like that. Us being a non-broker dealer, it allows our clients to invest in non-market traded assets or alternatives. And so that's really where our bread and butter is. So we want to help folks get into these deals that they wouldn't normally be able to get in, with a larger wirehouse or someone who has fiduciary responsibility, and the government might not want them or will not let them invest with an advisor attached to it, as these are non-market traded securities and thereby deemed a little bit more risky. So in order to get into these kind of investments, you need to have a custodian such as PENSCO. So that's what we do, and that's what we're happy to help our folks with.
Well, then another initial question. You said non-market securities. Is it only securities, or can you, for example, hold physical gold on their behalf?
So it's pretty much anything under the sun. There are a couple things that, according to the IRS, we're not allowed to hold. Precious metals are considered a currency, and so they can't be held outright. Now, that being said, it's still absolutely possible to invest in precious metals and things like Bitcoin or something along those lines, and there are ways to do that, so we absolutely can do things like that. We also have other things. We talked about private equity, we talked about real estate, but some other more unique examples would be mineral rights or cattle or fishing rights and things along these lines. So the possibilities are almost endless. Of course, the IRS does have rules, and that's what PENSCO is here to do, is to help navigate those and make sure our clients are doing everything in accordance with those IRS rules. But if you can think of it, you can almost hold it in an IRA.
Is the allure of uranium mines explained by the slowdown from 2014 to 2015 in S&P 500, where the S&P 500 grew almost 14% in 2014 and has gone up and down and sideways in 2015. Do you see more interest among self-directed IRA people in alternative assets as a result?
Absolutely. The market volatility is definitely an issue with folks that we speak with. In fact, we did a study or a survey recently of 1,000 of our clients, and out of those 1,000, 62%, said that market volatility was one of the biggest reasons why they chose to increase their allocations into non-traditional alternatives. And another 25% out of that said they intend to increase their allocation even more over the next 5 years. So it's definitely something that we're seeing an increase in. And that's just one of the reasons. Diversification also comes into play, also just investing in sections of the industries that you already are familiar with and have had success with. So there's a handful of reasons, but market volatility is definitely up at the top.
Okay, but your article did not focus necessarily on market volatility because, after all, we're talking about IRAs, which the middle word of IRA is retirement. So there's something about retirement, something about individual retirement accounts, which matches up well with certain alts. I was wondering if you would comment on that.
Sure. I think the main thing that we like to see here, or that we do see, is it's the time frame of these investments, right? A lot of private equity have, on average, a 7-year kind of lifespan to exit. And that can be a long holding period for people with taxable dollars. They don't want their dollars locked up that long. Well, in an IRA, you can't get access to that money or take it out of the account until you reach an age, or you got to start taking required minimum distributions. So these sorts of asset classes with these long holding periods make sense in a retirement account because you're holding them for numbers of years, if not numbers of decades to begin with. So this asset class really leans towards making sense using those tax qualified accounts.
All right, but they are tax qualified accounts, and you alluded to this earlier. So there's PE and there's PE. I mean, there are PE funds, there are PE firms, there are different kinds of PE funds. So if one wants to find out whether, for the purpose of a self-directed IRA, a PE investment is kosher or not, is that a question you can answer?
Absolutely. So we have 50,000 plus clients with individual retirement accounts, and we have about 40,000 plus unique asset types. So each one of those asset types actually does go through a review process. Now, again, we're not reviewing for fiduciary reasons or doing your classic due diligence that you would think of, but what we're reviewing for is something that we call administrative feasibility. Essentially, can this asset type be held in an IRA? And secondly, but just as important, are there any prohibited transactions or any disqualified parties? And that's something that the IRS looks very closely at, as we do as well, because we don't want our clients to invest in something that could possibly be a prohibited transaction or have a disqualified party involved, when the IRS starts looking. So absolutely, every asset goes through a review process, and we look very closely at everything that comes onto our books.
Well, you've used the two terms, prohibited transaction and disqualified parties. Whether in the context of PE or not, can you comment a little bit on what those things are or could be, examples?
Absolutely. So prohibited transactions, a common one that a lot of people like to think of, and a good example would be self-dealing. And in this example, it would be you're trying to purchase something via your IRA that you already own personally.
But that would help with this startup. We'd get all kinds of funding that way. They won't let me do that?
Exactly.
They won't let me do that. Oh, I'm unbelievable. Please go on. I'm sorry to interrupt.
That's right. So there's self-dealing. There's also, like you said, for your example, if you're starting your own company and you own the company 100% and you want to write a loan to the company via your IRA, that's not allowed either. Again, that's going to be self-dealing, and the IRS essentially looks at that as giving yourself a loan and not paying any distribution taxes on the money that you have in that retirement account. So there are a handful of things, and really it all comes down to IRS Code 4975, which, if the listeners want to get into the nitty-gritty of it, has the list of all the potential prohibited transactions and disqualified parties. But this is something that we look at every day because, like I said, with 50,000 clients and 40,000 unique asset types, you can imagine we see a lot of things, and we always want to make sure that our clients are doing the correct thing by the IRS.
Yeah, evidently you can't do anything anymore. So it's whereas I imagine there are opportunities to invest in KKR or funds created by KKR. Those would probably be a whole lot more kosher, for example.
Absolutely, and more kosher, maybe not, but the opportunity is there. Now, whether you're going to get into a hedge fund or a fund of funds or something more, along the lines of here in the Silicon Valley where you're investing in a startup, the review process is the same. Most funds and funds of funds are very aware of the rules, and so they have, retirement shares or employee shares or things of this nature to make sure that they work with those rules. But again, every asset's going to go through this review process, and while there are rules and limitations, you'd be amazed with what you can get. One of the first questions or first things I always hear when someone asks me, can I do this, can I do that? And I say, absolutely. And they say, wow, I had no idea I could do that. And that's a pretty common theme. So very glad to be on here and kind of spread the awareness.
And I guess some of that surprise comes from the limitations that are placed on broker-dealers with whom they may have been interacting before on such questions.
Absolutely. If you were to ask your financial advisor to help put a rental property in Tahoe in your broker-dealer account, the answer you would get is probably with a very quick and decisive absolutely not. But that doesn't mean it can't be done somewhere else. It just means it can't be done at that particular place.
That's an important point for the democratization of investment finance. So you've mentioned diversification, and most people have some idea of what that means. But we're diversifying, when we talk about diversification, we're principally diversifying from the overall public equities market, aren't we?
Correct. And, one of the main things, and I alluded to this earlier, is we always want to tell our clients, invest in areas and in industries that you already know. You're using your retirement dollars. You're taking a section out of your portfolio to diversify and to make, what you think is a prudent investment in an industry that you wouldn't be able to access via one of your broker-dealers. And so, real estate people obviously like to invest in real estate. We have folks who are very private equity focused, and they're going to be more inclined to fund the next startup or invest in a fund of funds. And so it really depends on, what you're currently invested in, what your risk tolerance is, your timeline, all the normal things that you would think of. Of course, you got to do your due diligence, make sure you know what you're getting into. But that's what we're here for. We're here to make it possible for you to invest in the things that you actually want to invest in.
I guess I'd like to mention on the side that Financial Boys Webinars recently produced webinars on two of them, one on the nuts and bolts of private equity and one on the nuts and bolts of hedge fund investing. And in both cases, I was moderating each of them. So I know in both cases, to say the word PE fund or hedge fund, and I'm not saying you were doing this, but to say those words does not automatically make whatever it is diverse from the market. It depends a lot on the strategy pursued by that particular fund. And
absolutely.
Yeah. And that's something you could educate people on, although not advise them.
Exactly. And just because, like you said, it has the word PE or the letters PE or the words private equity in it doesn't mean it's doing anything different necessarily. Everyone has their own strategies and their own focus. And again, you always want to do your due diligence, know what you're getting into, understand, what it is that the fund is trying to accomplish and how they're trying to accomplish that, and invest that way. Some are, laser focused with one company in an LLC or an LP form, and some are all over the boat and, have multiple investments happening within the fund. So it really depends on where your opportunities are, and obviously doing your own due diligence and making sure you know what you're getting into.
Well, now I'd like to ask a question about the tax man, and not only does he hem you in as far as your choice of what you can put in a self-directed IRA, but I was reading a recent article in the Wall Street Journal about a shocking little tax bill somebody got after his self-directed IRA in a master limited partnership generated some taxes he certainly did not expect. Is that the sort of thing you guys keep a hold on, and how do you deal with it? Evidently, custodians deal with it in different ways.
Yeah, there are a variety of different ways that this can be done. With a common thing that comes up would be, UBIT, which is probably what you're alluding to. And
yes,
go ahead.
UBIT stands for what?
Unrelated business income tax.
Okay.
And
good.
So this is what happens when it's an operating company, essentially, and some taxes do have to be paid in. Eventually, that's going to come back to the investors. Those taxes, if the IRA is a holder, will need to be paid via the IRA. What we require is to be notified of the amount that needs to be paid, and we will cut that check to the IRS out of the client's IRA. It tends to have a little boogeyman stuff behind it. People are intimidated, but as long as your capital raiser, asset sponsor, fund sponsor, whatever you want to call him, is aware, and most definitely should be, as you've given him some dollars to invest in the fund. They'll let you know what's owed via K1. The K1 will come to us. We'll go ahead and cut the check to the IRS.
Okay, but not all custodians do cut the check, I understand.
That could be, and I can't speak to everybody. I can definitely speak to what we do, and we absolutely want that check coming out of the IRA. The IRA is officially the owner of the asset for the benefit of the client. So all expenses and or dividends that come in have to flow back through that same account that made the original investment. So in the event of taxes being owed, PENSCO does absolutely want to cut that check to the IRS, but again, we do need to be notified of the amount that should be going out.
Okay, I appreciate that. Now I was going on a journalist, and who knows. All right, let's ask a few questions in the other direction. We've had changes in recent years with the Jobs Act, and now with real crowdfunding regulations having come on board and will be effective in a few months. Mm-hmm. How does that change? Imagine there are some companies out there, perhaps startups or others, who see new investors on the horizon.
I would definitely think so. The rise of the Jobs Act and Title III are going to open up these Reg D offerings to non-accredited investors. This has been a very inside club for a long time, the industry, I should say, of investing in these sorts of assets. And with the rise of the Jobs Act and Title III, this will definitely open the doors for the everyday person to make these opportunities happen for themselves. So I would expect definitely to see a rise. Time will tell. It's still too early to say, but with that option out there, I'd absolutely assume that we would be getting a little more traffic as the opportunities trickle up to everybody or trickle down.
Well, I guess one of the ways a custodian can really bring value is by making things administratively easier. And so now I'm thinking, having asked the immediately prior question, that custodians might come up with some administrative solutions to handling larger numbers of investors through individual crowdfunding and so forth. I mean, I guess maybe that's a potential value proposition for your industry.
Absolutely, and we're very excited about it. We currently have what we call our PENSCO Marketplace, where there are 15 to 20 equity crowdfunding sites on there, and we have solutions to work for that type of thing. Essentially, once an asset is approved for one person, it's open for all the people who are eligible to invest in that again. So for an example, say a startup and they're doing a subscription amount of $5 million or so, if that first person gets through the door, now for the additional investors coming in, that capital raiser just needs to send us the new subscription along with the authorization of the individual client, and that review process doesn't have to be done every single time. So once it goes through one time, we have it on the books, we've done our review, we know it's good, we know it's administratively feasible, and now they can start bringing in the rest of their investors relatively easily.
Awesome. Well, let's finish by going back to private equity, which after all was the focus of your article and has been the focus of much of what we've discussed. And I know that PENSCO has done a good deal of research of their clientele and of others. Now, private equity has not had the best year either. Is it still on the upswing for customers of custodians?
No doubt, and I think it's going to continue to rise. For example, last year, 60% of the new accounts that we opened up ended up investing in private equity. Historically, we've been open since '89, so almost 3 decades. Real estate's kind of been the backbone early on, but private equity is making a strong charge to take that over. In that same client survey that I referred to earlier, 25% of our clients said they're likely to increase their allocation in private equity, in an investment like a startup or a fund. So I definitely see the private equity trajectory continuing to go up, especially with the Jobs Act and Title III. As these things become more available, the knowledge about them becomes out more and more people have the opportunity to invest. I think that trend will continue, and I think the private equity train will continue to run strong.
Yeah, I guess it's one thing to look slack-jawed at Steven Schwartzman's birthday party, and it's another to think, I could put some dollars in these things. So it's a new world.
Absolutely. I mean, it's an exciting time, and people every day now are seeing in the news about the next great IPO that's coming out, and all the things that, it's more publicized now than ever. And I think the average person, and they're going to want to get a piece of that, and so they're going to look for their opportunities where they can find them. And I absolutely think that private equity will continue to be the fastest growing asset class for us. There's a lot of retirement dollars out there. Nearly 1 in 4 every U.S. household has an IRA. There's more than $7.6 trillion held in IRAs. About $152 billion of that is held in self-directed IRAs. So they're gaining, the self-directed portion is gaining at nearly twice the rate of traditional IRAs. So I think with that kind of number, you're going to see a lot more people investing in private equity and also real estate and other alternative asset classes. But that private equity class is definitely the leader in the pack right now.
Well, Christopher Orr, Director of Institutional Products with PENSCO Trust Company, thank you for being with us.
Thank you so much, Chris. I really appreciate it. Thanks again for having me on.
And to the listeners, don't forget his article, A Little Known Option for Investing in Private Equity, which is on AccreditedInvestorMarkets.com. This has been Accredited Investor Markets Radio. Accredited Investor Markets Radio is produced by Stephanie Strait. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short-written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.